Every real estate versus stocks video you've ever watched picked a winner before they ran the numbers. This one doesn't. And the real answer might be the last thing either side wants to admit. All right, let's set this up fairly. Two investors, same age, same city, same $50,000 in savings, same salary. The only difference is what they do with that money. Mongu uses the $50,000 as a 20% down payment on a $250,000 rental property. 3 bedrooms, decent neighborhood. Mortgage at 7%, monthly payment around $330. He finds a tenant at $1,800 a month. On paper, that's $470 a month in cash flow before expenses. Mongu feels like a genius. He drives past the house on his way to work and thinks, I own that. Manji takes the same $50,000 and puts it into a total stock market index fund. No leverage, no tenants, no keys, no story to tell at dinner. She sets up an automatic $300 a month contribution and then basically does nothing. When her coworkers ask what she's investing in, she says index funds. They nod politely and change the subject. Nobody is impressed. And that right there is the first thing almost nobody talks about in this debate. The psychological experience of these two investments is completely different. Mongu's investment is visible, tangible, and socially impressive. Mongi's investment is invisible, abstract, and boring. And that difference in how it feels, that changes every financial decision both of them make for the next 20 years. Okay, for the first year, Mongu is living the landlord dream. Rent hits the account on the first of every month. He's claiming mortgage interest and depreciation on his taxes. The neighborhood is appreciating. Everything feels real and smart and working exactly as advertised. Then year 2 hits. Here's what comes out of that $470 a month cash flow before Mongu keeps a single dollar of it. Property taxes, roughly $3,000 a year. Insurance, another $1,500. He replaced a water heater in year 2 for $1,200. A roof leak in year 3 cost $2,800. 1 month of vacancy between tenants meant $1,800 in lost rent, plus $600 to relist the property. Oh, and Mongu manages the property himself to save money. So that's late-night phone calls, weekend showings, and coordinating repairs on his lunch break. He's not getting paid for any of that time. After every real cost over 3 years, Mongu's actual net cash flow is somewhere between $2,000 and $4,000, not $16,920, $2,000 to $4,000, over 3 years. On a $50,000 investment, that doesn't include a single hour of his time. Oh, that's kind of rough when you think about it. Okay, before the real estate people start yelling at the screen, let's talk about the thing that makes real estate genuinely powerful. Leverage. Mongu used $50,000 to control a $250,000 asset. After 3 years of appreciation at 3 to 4% annually, that property is now worth roughly $270,000 to $280,000. His equity has grown to about $55,000 to $65,000. That is real wealth, and a big chunk of it came from using the bank's money. That 5-to-1 leverage is the single most powerful advantage real estate has over stocks. And it's the reason this comparison is never as simple as people pretend. Meanwhile, Manji has put in $50,000 plus $10,800 in monthly contributions over 3 years. At roughly 10% average annual return, the historical average for total market index funds, her portfolio is sitting at approximately $76,000. 0 hours managing it, 0 phone calls, 0 emergencies. But here's what Mangi does not have that Mongu does. Leverage. Mangi used $50,000 to control $50,000 in assets. Mongu used $50,000 to control $250,000 in assets. That gap matters. And there's no depreciation, no tax shelter, no tenant paying down her loan. Mangi's wealth grows, but it grows on exactly what she puts in and nothing more. So who's winning? Well, that depends on what year you check. By year 10, Mangu's property is worth roughly $335,000 to $350,000. His remaining mortgage is about $166,000. His equity sits around $170,000 to $184,000. His total out-of-pocket beyond the down payment over 10 years? Somewhere between $20,000 and $40,000. Manji's portfolio, with consistent $300 monthly contributions, is sitting at approximately $165,000 to $180,000. She put in $86,000 total. The rest is pure compound growth. At year 10, they're surprisingly close in total wealth. Mangu might be slightly ahead thanks to leverage, but Mangu also spent hundreds of hours managing the property, took on $200,000 in debt, and concentrated his entire investment in a single asset in a single zip code. Mangi diversified across thousands of companies and never lost a night of sleep over it. All right, real talk time. These are the real estate costs that almost never make it into the analysis. Vacancy. The average rental sits empty roughly 1 month per year. That's a full mortgage payment with zero income. Maintenance. Budget 1 to 2% of the property's value per year. On a $250,000 house, that's $2,500 to $5,000 annually. Some years it's a $200 faucet, other years it's a $7,000 FAC replacement in August and your tenant is threatening to leave. Capital expenditures, roofs, furnaces, water heaters, these are guaranteed future costs that arrive in chunks of $5,000 to $15,000. If you're not setting aside money every month, you're not running an investment. You're running on luck. And luck has a billing date. Bad tenants. One tenant who stops paying and knows the eviction process can cost you 3 to 6 months of lost rent plus legal fees. That single event can erase an entire year of profit. Now let's be equally honest about the stock side. In 2008, the total market dropped approximately 37%. In March 2020, it crashed 34% in a single month. If Mangi had $150,000 in her portfolio and watched it fall to $95,000 in 4 weeks, that is gut-wrenching. And the data shows most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the exact worst moment. The strategy works perfectly if you hold through everything. Most people do not hold through everything. Also, there's no cash flow. Index funds don't send you a monthly check. On a total market fund, you're looking at roughly 1.5 to 2% yield. On $150,000, that's about $200 a month. That's not replacing anyone's income. And the boredom is real. There is nothing to do. That's the point. And it's also the problem. Here's the part that changes the math more than anything else. If Manji increased her monthly contribution by just $200, from $300 to $500, her 20-year portfolio jumps to roughly $550,000 to $600,000. In the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying a second property, taking on a second mortgage, doubling your workload overnight. By year 20, Mangu's property is worth roughly $450,000 to $500,000. Mortgage paid off or close to it. Equity between $400,000 and $500,000. After 2 decades of maintenance, repairs, tenant turnover, taxes, and insurance, total net profit from cash flow is somewhere between $50,000 and $90,000. Mangi's portfolio at 10% average annual return with $300 monthly contributions has grown to approximately $420,000 to $460,000. Total contributions over 20 years, $122,000. The remaining $300,000 plus is pure compounding. No debt, no tenants, no 2M phone calls about a broken pipe. At year 20, they're in the same general range, somewhere between $400,000 and $500,000 each. But how they arrived there is completely different. Mangu worked for his. Mangi waited for hers. By the way, if this is the first Mango Economics video you've seen, we break down money concepts exactly like this every week. Inflation, banks, stocks, compound interest, all of it. Hit subscribe so you don't miss the next one. Trust Mangu and Mangi, it only gets more interesting from here. So what's the honest answer? Here it is. If you have local market knowledge, time to manage a property, the temperament for illiquidity and unexpected costs, and access to a market where the rent-to-price ratio supports real cash flow, real estate can build wealth in ways stocks simply cannot. If you want simplicity, diversification, liquidity, zero management time, and the ability to scale without adding complexity, index fund investing will build comparable or superior long-term wealth with a fraction of the stress. And if you can do both, owning property in a strong rental market while consistently investing in index funds, the math on that combination is the real cheat code. And that's exactly what the next video is about. The most important question isn't which one wins on average. It's this: did you include everything? Because the answer that includes everything is the only answer that actually matters. If this gave you a clearer picture of how these two investments really compare, not the thumbnail version, but the real version, hit like before you go. Subscribe for weekly economics breakdowns that actually make sense. And drop a comment. Are you Team Mangu, Team Mangi, or Team both? We read every single one. See you in the next one.